Just let me know if my screen is visible to all. So we'll be talking about the price earning growth ratio today. So in the previous session, we discussed about the price to earning ratio. We talked about everything about the price to earning ratio that can be possibly taught to you from a theory perspective also and from the practical perspective also. So we tried to combine both the approaches into that particular session where we try to understand the price to earning ratio. Now, this session in particularly has been focused towards understanding the PEG, the price earning growth ratio. Again, this ratio is a very important ratio and it tries to overcome the limitation of the price to earning ratio. Now, what is the limitation of the price to earning ratio that we have already discussed? We will be trying to touch a bit of it in this session also. But deep dive, we try to understand the biggest limitation with the price to earning ratio faces while performing the company valuations or trying to value a specific company, right? So you can watch the previous video and revise that session and come back to this once again. Okay. So if I just talk about the price earning growth ratio, so as the name suggests, price earning growth. In this ratio, we are trying to talk about the earning growth of a firm. In the previous video, we talked about the price to earning ratio. In the price to earning ratio, we just talked about one constant earning of a firm, right? So if we talk about the price to earning ratio, if I just go back to the previous session, the formula was what? The formula was the current share price, the current share price in the numerator and dividing it by the EPS of the firm, right? So we take into account the current share price in the numerator and the EPS of the firm in the denominator. And the earning per share being the proxy of the profit after tax of a firm, or simply the proxy of the profitability of the firm. Higher the profit the firm makes, higher shall be the EPS of the company, right? But in this, we took a standalone number, EPS, an absolute number. In this case, we did not take into account the percentage rate of growth in EPS. The earnings growth of a company are also called as the EPS growth of a company. When we say that the earning growth rate of a company, when we talk about, or like whenever we see on a social media platform, or like wherever we try to understand about the earnings growth of a company, we tend to talk about the growth rate in the EPS of a firm, the growth rate of the earnings per share of a firm. This term is very popularly being used on various news platforms, various financial news platforms like CNBC TV 18, Z Business, NDTV Profit, Bloomberg TV. They say that we expect the earnings growth of the firm should be 2%. We expect the earning growth of the firm should be in a higher single digit, a lower single digit, a lower double digit. So whenever they're talking about the earnings growth of a firm, they're talking about the growth rate in the EPS of the firm, the growth rate in the earnings per share of a firm. But when we talk about this price to earning ratio, in this price to earning ratio, to be very specific, we are taking an absolute EPS number. We aren't taking into account the growth rate in EPS, right? And again, trying to touch a bit of the biggest limitation of the price to earning ratio, just to set the context. The biggest limitation of the price to earning ratio was it doesn't take into account the growth rate in earnings. It just takes into account 1 year's past EPS, or even if you're trying to calculate a forward-looking price to earning ratio, be it a 1 year forward-looking price to earning ratio, right? In that case, also, we're taking into account the expected EPS of a company. And that is just one standalone number. And one standalone number doesn't tell you always about the entire valuation of a business. Be it the past trailing EPS, which takes into account the past 12-month EPS, and that becomes a raw material or input in the calculation of the price to earning ratio, or be it the forward-looking EPS. Again, if you're trying to create a financial model and doing the valuation of a company, trying to forecast the company's financials and calculate a forward-looking EPS or a forward EPS, again, that number becomes a denominator in the price to earning ratio, which gives us the forward price to earning multiple again. In that also, we are taking 1 year expected EPS. And 1 year EPS doesn't always indicate future performance. 1 year's past EPS doesn't always indicate future performance, because there might be situations in which the 1 year EPS of a company might be boosted on account of some extraordinary earnings or exceptional items. And the vice versa is also true. It might happen that the EPS of the company might have drastically come down on account of some extraordinary items or exceptional items, right? Or it might be a cyclical business. right? So on these kinds of scenarios mislead the price to earning ratio. There are multiple other scenarios also that tend to mislead the price to earning ratio. We have talked about that in the previous session. But one thing that we need to understand is if we talk about the numerator of the price to earning ratio, in the numerator, we see the current share price. The current share price fluctuates on daily basis. The price of a share tends to change on daily basis. It might not change by great quantum, but will definitely change even by some decimals because some kind of buying and selling is always there into every stock in the market. The price might not change in a higher single digit, but maybe in decimals, but the price tends to fluctuate or the price tends to change on daily basis. But if we talk about the earnings per share of a company, EPS, it doesn't change on daily basis because EPS is a proxy for profit. You can only calculate the earnings per share when you know about the profitability of a company. And the company declares the profitability either quarterly or annually, right? Because all these numbers are declared on a quarterly basis or annual basis. A company never declares its profit on daily basis. And hence, you cannot calculate a daily EPS. So we came to a conclusion while trying to understand this price to earning metric was the numerator that you see, the current market price is the leading indicator because it tends to change on daily basis on account of positive sentiments or negative sentiments, market fluctuations, some positive or negative market news might come into place. Whereas EPS is not a leading indicator, it is a lagging indicator because this number we have taken the historically quarterly EPS or the historically annual EPS, the latest published number that we have. So as of now, if someone says me to calculate the price to earning ratio of a company as of today, so I'll be taking the current market price as of the Friday close and taking the EPS as of the latest quarter ended data, maybe for the December 2024. And if I want to have the yearly ended data from an Indian parlance, I might take the data as of 31st of March 2024 ka EPS, right? So that is one thing. It's on your choice, like whether you have to calculate a quarterly EPS or an annual EPS. The annual EPS is the best thing because again, that is used in your financial modeling and valuation also, right? So that was the biggest limitation that 1 year EPS or one quarterly EPS might not be able to project the future EPS or might not be able or might not be a greater indicator to project the future prosperity of the firm in terms of the profitability, right? And that is why here the price earning growth ratio tends to come into account. It overcomes the biggest limitation of the price to earning ratio. It takes into account the price to earning in the numerator. So this whole ratio that we have calculated, both the numerator and the denominator, this whole ratio of price to earning a number, it is a part of the numerator of the PEG ratio. So whole price to earning becomes the numerator. And in the denominator, you have the earnings growth of the firm. And the earning growth are being simply represented by the earnings growth in the EPS of a firm, by how much percentage the EPS of the firm is growing, which basically gives you a much better picture, a much more clearer picture as to the growth rate in the earnings of a firm. Now, the question might arise, if you're taking into account the growth rate in EPS, again, which is a percentage number, how many years ka data we have to take into account? Either you can take a 5 years ka data, you can take a 5 years EPS for year one, for year two, for year three, for year four, for year five. You can simply take the growth rate in EPS, that how much the EPS has grown in year two compared to year one, like simple percentage formula. Year two EPS minus year one EPS divided by the year one EPS. Same you can do for year three, for year four, and year five. So you shall be having 4 percentage numbers year on year growth or decline in the EPS. Just take the average of the growth rate of EPS and take that number in the denominator. Some people tend to take the fifth year ka EPS and first year ka EPS and they tend to take out a CAGR. Again, that approach is not extensively encouraged because you tend to ignore the fluctuations in between. It might happen that year one ka EPS might be too low, the base might be too low, and the year five's EPS might be sheerly high. Again, it might give you an obsolete number, a number which might be overvalued, a number which might give you a false picture. So the best way is to take an year-on-year comparison with how much the EPS has grown year on year. So for example, if in year two, it grew by 5%, in year three by 6%, in year four by 7%, in year five by 8%, take the average of the four, 4 plus 5 plus 6 plus 7 by 4, simple average. So basically, we're taking individualistic percentages, how much year on year percentage the EPS has grown, and simply taking out the average growth rate in EPS over the past 5 years. That's it. कुछ नहीं करना. Year 1 में अगर मान लो your EPS is, and this I'm talking about past EPS, right? If as of today I want to know that what is my PEG ratio, right? So पिछले 5 years का I'll be taking into account my EPS first. Assumingly the last 5 years in year 1 it was 5. In year 2, it became 10. In year 3, it became 8. In year 4, it became 15. In year 5, it became 20. So I'll be taking a simple percentage formula, right? यहाँ पे तो सीधा like 100% से ही बढ़ गया है. Then I'll be taking what? For year 3 and year 2, 8 minus 10 by 10. That makes 2 by 10, right? So try to convert this number into 100. Simple math दिखा रहा हूँ मैं. That makes it 20%. अब यहाँ पे जो नंबर आएगा, मे बी द परसेंटेज इंक्रीज अराउंड 16%, एंड यहाँ पे द नंबर इंक्रीज अराउंड 8%. जस्ट टेक द एवरेज 1 + 20, मे बी सब कुछ अगर लाइक परसेंटेज में ले रहे हो लाइक 100% + 20% + 16% + 8% by 4. So simply you have taken the year-on-year growth in the EPS and simply taken out the average. Simply taken out the average. And that number you can take in the denominator of this ratio. Simply that number can be taken in the denominator of this ratio. So again, it will not give you an exact picture, 100% accurate, but a much better picture as compared to the price to earning ratio, which takes into account only 1 year's absolute EPS, right? Which might not be useful in many of the scenarios. The biggest limitation of the price to earning ratio is it takes into account just 1 year's EPS absolute number, which might not be a forward-looking indicator. If you talk about the price earning growth ratio, it is basically following a trend, which is a much better indicator, not completely accurate, but a much better indicator that based upon past 4 years data, 5 years data, how much is the EPS of the firm growing, and taking that average single number growth rate into your denominator and calculating the price earning growth ratio. So usually what happens if your PEG ratio or the price earning growth ratio is less than 1, it means the companies or the index is undervalued. If it is more than 1, it means it is overvalued. So if you find any particular company or a stock or simply an index having a PEG ratio of closer to 1, maybe 1 or 1.1 is also fine, 0.9, 0.8, that index or that particular company stocks company is undervalued. But if you find very higher PEG ratios, 1.5, 1.6, 2.1, it means the companies are sheerly overvalued. And that was the example, a very classic example, which I have been giving in my previous sessions also, the overvaluation of the small cap and the mid cap space. Though, even after the mid cap is being corrected by approximately 14 to 15% from October high, from September high per se, small caps being correcting by more than 20% from September high, large cap correcting around 12 to 13% from September high, right? Large caps have become undervalued. If we talk about a 1 year forward, price to earning ratio for the Nifty 50 index is trading at 19.5x, not even 19.5x, exactly 19 as of now. Whereas historically, the number has been 20.5. But the mid cap and the small cap is still high, right? Small cap around like 17 and 23 is trading around like 23x. Average is 17. Mid cap is trading around the mid cap 250 index, I'm saying, is trading around 28x, the average being 23x on a price to earning multiple. And there's a Nifty 150 mid cap index I'm talking about. The average past 10 year has been 23x on a price to earning multiple. But the 1 year forward price to earning multiple is trading at a 28x as of now. And Nifty small cap 250 index, the average 10 year is around 17.3x on a price to earning multiple, but currently is trading at a 23x price to earning multiple. Even after being correcting by 14% for mid cap and 20% for small cap, the mid cap and the small cap indices are still sheerly high. But again, there are good quality stocks within those indices also. The index being higher at a price to earning level overall, it doesn't mean that every stock in that index has lost its value. There's still good quality, growth oriented value picks in those particular indices where you can think of buying those stocks and keeping in the portfolio for long-term perspective. So what basically happened, the major issue or the major problem that everyone faced was I should be audible now, right? Like there was some network connectivity issue in between. I should be. I'll just start resharing my screen once again. Correct. Huh. Okay. So what is basically happening if we talk about 2022 or 2020? So basically starting after from the COVID-19 pandemic, from 2021 to approximately 2024 end, right? From 2021 to approximately 2024 end or till early September, I would say the large caps have given around 22% return. Okay. The large caps have given around 22% return. Okay. For those who are asking that where they can access the previous recordings, just go on the website. The latest uploaded last module is the latest recording there, right? And they're like, you shall be having the session on the price to earning ratio. Just simply go on the website and the last uploaded latest module, right, is upon the price to earning ratio. So whatever latest things that we are trying to upload on the website, we tend to mark it as updated modules, right? Or the updated lectures. Just try to refer that and like you'll be finding the latest lecture out of that. And you even have the dates, right? The current dates beside the modules, right? On what particular date the module had been uploaded. So that is one thing. So, एक second. ठीक है. So thing is, from 2021 to approximately 2024 early September or late September, a large cap Nifty 50 index has given you a return, or not, I would talk about return, but the EPS growth rate has been approximately 22%. That is, the growth rate in the earnings of the large cap companies have been approximately 22% from 21 to 24, approximately for 3 years. If we talk about the mid cap companies, it has been 36%. The earning growth of the mid cap companies from the fiscal year 2021, right, to the 2024 late September, it has been 36%. But for the small cap companies for the same time period from FY21 to approximately 2024 late September has been 48%. So 22% for the Nifty 50 index, 36% for Nifty 250 mid cap index, and 48% for Nifty 150 mid cap index, and 48% for the Nifty small cap 250 index. So simply अगर हम बोले, the large caps have given approximately 22% earnings growth in EPS. The mid cap has given how much? मैं यहाँ पे लिख भी देता हूँ. Large caps have given around 22% earnings growth in EPS. Mid caps have given around 36% earning growth in EPS, and small caps have given around 48% earning growth in EPS. We all know that the growth rate of the mid cap companies and the small cap companies is much more higher as compared to the large cap companies, because large cap companies are much mature. Still growing at 22% is really good. On an average, they tend to grow by 10 to 11% only. But since it was a revenge demand for multiple stocks, for multiple services after the COVID-19 pandemic, hence many stocks from all these spaces grew by sheerly greater margins. But the mid caps have a higher potential as compared to large caps, because many of the mid cap companies tend to become large cap companies in future. They tend to get added into the Nifty next 50 index, or sometimes also, not sometimes, but many times into the Nifty 50 index also. But the probability of a small cap company becoming a mid cap company is less, because many of the small cap companies get away from the markets. They go into bankruptcies, the business gets shut, and they go into micro caps, because those are the two risky companies. And if they're growing, they will grow by a higher percentage in terms of earnings, in terms of cash flows, in terms of XYZ properties. But large caps will grow by a lower amount, mid cap higher than large cap, and mid caps are much more safer than small caps also. They give you good returns, a reasonably good return, because 48-50% is sheerly high return. 36% is also sheerly high, but a very good return. And that is why many of the companies have come up with a large and mid cap fund nowadays, because they believe that many of the mid cap companies can become large cap companies with lesser risk, because the earnings of the mid cap companies also are much more higher than small cap companies in terms of longer term averages. Over longer term averages, over a 20-year period or 15-year period, the mid cap earnings tend to converge to 14% growth rate. That is, the EPS growth rate of the mid cap earnings tends to converge to 14% over a 15-year, 20-year timeline. For small cap, it is less than 14%. It's around 12 to 13%. Same as large cap, closer to large cap, right? So mid cap being safer, mid cap giving you higher return potential, over any other index on a risk adjusted basis is giving you much more potential to grow, right? Because many of those China plus one themes, EMS companies, your fertilizers, your Make in India theme companies, your capital goods, infrastructure space, many of these are present into the mid cap space. Many of the consumer discretionary space, IT companies, growing IT companies into AIs and technologies are present, consumer tech companies are present into the mid cap space. Zomato is entering the Nifty 50, right, from the mid cap to large cap, correct? So many of these companies have a potential of becoming large cap companies straightforward from mid cap with a higher growth rate in EPS. So coming back to our valuation topic, the thing was, over these years, we have seen the growth rate of especially the mid cap and the small cap companies being sheerly high. So what basically happened, the mid cap and the small cap companies specifically were being overvalued in terms of price to earning ratio. So they're still overvalued, but at that point of time, they were sheerly overvalued in a bubble territory, basis upon the price to earning ratio, right? But the thing was, at that particular point of time, those who just based their results or who just based their stock picking, I would say, chances or stock picking abilities based upon the price to earning ratio, they sold off many of the mid cap and the small cap stocks in the portfolio. I'll repeat my point. Many of those fund managers or the portfolio managers who believed just upon the price to earning ratio, they sold off many of the mid cap and the small cap companies in 2023 or early 2024, January, February max, because they believe the companies are surely overvalued. But when they used to sell off in the market, right? They used to sell off in the market to hedge their client's portfolio, to have a much more composition towards the large cap, right? They weren't able to deliver the alpha for the clients, the exit return over the benchmark for the clients. But those fund managers who still kept the mid cap and the small cap stocks in the portfolios were able to give the extra alpha or the excess alpha to their clients. So many of the risk averse portfolio managers, they sold off in 2023, in 2024 early. Mid cap, small cap being sheerly overvalued, it's time to sell off those stocks. But again, they rose and rose. The market cap for the mid cap and the small cap still rose even after those sold off the stocks. Because many of the fund managers or the retail people on the other side of the business were still buying the mid cap and the small cap companies. Because they were framing their decision based upon the price earning growth ratio. The price to earning ratio was more than 30, 40 for the mid cap and the small cap. But the PEG ratio was closer to 1. It was 1, exactly 1. Sometimes it was 0.9. Sometimes it was 1.1 also, but closer to 1. And that clearly showed the year-on-year earnings for the mid cap and the small cap companies are much better. And that is why they're commanding a closer price to earning growth ratio. But the price to earning ratio became surely overvalued. But again, the price to earning ratio was again be justified, because theoretically, we always say that buy an undervalued stock and sell an overvalued stock. As per theory, we always say that buy an undervalued stock and sell an overvalued stock. But if the growth rate in earnings is supporting the overvaluation, then what's wrong in even buying an overvalued stock or keeping your positions neutral? That is neither buying nor selling. Till early 2024, we saw the same case for the mid cap and the small cap companies. The growth rate in earnings were extremely strong, 36%, 48%. They became overvalued based upon the price to earning ratio. But if the price was rising for such companies, especially for the mid cap and the small cap, the earning growth in the EPS was supporting that price. Jab tak the earning growth in EPS is supporting the price of a company, it's good to go for that stock, right? So since PEG ratio में क्या हुआ, right? Basically, what happened? The growth rate in earnings were justifying the PEG ratio. So whenever someone says you that a company is overvalued based upon the price to earning ratio, it might be fine. But always look at the price earning growth ratio while taking into account the growth rate in the EPS of a firm. And that will give you a much more clearer picture. A firm's 1 year's EPS might be sheerly high. Based upon that, you cannot forecast the company's financial based upon this 1 year ka past EPS. You need to have multiple years EPS, and that the PEG ratio takes into account. And on account of the PEG ratio, the mid cap and the small cap were fairly valued. Based upon the price to earning ratio, when I agree, they were sheerly overvalued. but the earnings were supporting that higher price. But from the previous 2 quarters, the earnings started to degrade. For large cap, they became they became undervalued, but the mid cap and small cap के लिए भी हुए. Now the mid cap earnings have converged to 14% now. Small cap earnings have converged to 12% now, like closer to their long year 15, 20-year averages. Right? But the prices are still high. They're still in the bubble territory. And again, that growth rate in earnings is not supporting that price now. And that is also one of the reasons why many of the fund managers and many of the people have started to sell off the mid cap and small cap stocks, because the growth rate in earnings is not supporting the price. Till the previous year, from 21 to 24, initially, the growth rate in earnings supported that price. But now the growth rate in earnings is not supporting that price. So they have become overvalued based upon the PG ratio also, because now your denominator is very less number. That's 12, 10%, 12%, 14%. But the price to earning ratio is high, around 30, around 28. Correct? So it's not able to justify those earnings now. It's more than 2. It's more than 2 or like 1.8 approximately for such companies. That is one thing. Are in large cap safest? Agreed. I'm agreeing to your point. Large caps are the safest because the long-term valuations trade at around 20.5x, but they're currently trading at 19.5x price to earning ratio. Large caps are the safest bet. Large cap will give you the most safest return, around like 12 to 13%, not even 13%, around 12%. The 10-year CAGR of large cap companies is approximately 12.5%. Because the large cap companies are less risky now. They won't collide, they won't go into bankruptcy, they won't go out of the market. A few of the companies might enter into the Nifty next 50, they might get kicked out of the Nifty 50 because quarterly rebalancing is being done by the BSE NSE. And 2 or 3 of the companies get kicked out of Nifty 50 and they become part of the Nifty next 50. Right? But the large cap index on an average 10-year basis will give you a 12.5% return as of the previous history that it says. But it's the most safest one. You aren't taking that additional risk for extra return. If you want to make extra return, you have to take that additional risk in the market while going into the mid cap and the small cap space. And that is one thing you can think of, right? But the earnings should justify it. At this particular point of time, the earnings of the mid cap and the small cap are not justifying the higher valuations. The earnings of the mid cap and the small cap are not justifying the higher valuations. Till the previous year, till late, I would say till early June or July, it used to justify. But after that, we have multiple quarterly earnings, like 2 quarter earnings we have, like one for December and like one for September. They were downgrades. The earnings collapsed, the earnings came down, but the valuations were still high. For large cap, things were okay. They have become undervalued now. They have to grow now, right? They have to sustain their businesses. But it's a challenge for the mid cap and the small cap companies. So it's very much important not to pick up those mid cap indices or small cap indices directly, but pick up good quality, growth oriented value stocks within those basket. Right? तो पूरी basket नहीं खरीदनी. Good quality, good growth companies may be undervalued if you can find is the main thesis within the small cap bucket, the small cap 250 bucket, and the mid cap 150 bucket. And that's the thing. So that is where the PEG ratio comes into account. Once the PEG ratio falls below 1.5, 1.2, 1.1 पे आता है, again people will start to purchase the mid cap and the small cap indices. Now they're still purchasing it for long term perspective, because if you have a long term perspective for 10 years, 15 years down the line, then even now people are purchasing the mid cap and small cap stocks because they know that even if the market falls much more by like 5 to 10% more, the mid cap and small cap portfolios will still fall. But over the long term, on a 10-year, 15-year basis, it will give them exponential return. So that's a long term perspective. If you want to make returns in just 1 year and 2 years, never enter into the small cap and the mid cap space. Then go for large cap. Even in that case, the large cap also might not be good because there are certain years in the past where the large caps have not performed for like 1 or 2 years. Correct? The best way in that case is to go for FDs. But if you want to enter into equity markets, you should have a time horizon of at least more than 5 years to make the best potential out of it, to make the best alpha for your stocks over the benchmark. Because the main aim of the active fund manager is he wants to beat the benchmark, right? If he is not able to beat the benchmark, right, then go for passive, right? It's much more important to go for a good quality active fund which can beat that benchmark or has been beating the benchmark from previous 5 to 10 years. Again, that sustains performance, right? That is one thing. We need to understand the relationship of the price of like both these ratios, right? I'll just uh, erase the extra part. And once we understand the relationship, we can just end the session with. But these are weekly sessions I will bring on like 1 or 2 ratios, deep dive. Okay. देखो, if you talk about the PEG ratio and you talk about the P ratio, okay, they're related to 3 things. One is your interest rate, then you have the risk and growth. And same for the price to earning ratio, they have a relationship with the interest rate, with the risk and growth. So if we just talk about the first component, that is the interest rate. So with the interest rate, both the price earning growth ratio and the price to earning ratio exhibit a negative relationship theoretically. I'll tell you the practical implications. What do I mean? If the interest rates in the market are low, the price earning growth ratio or the price to earning ratio will be high. But when the interest rates are high in the market, there might be a liquidity crunch scenario. There might be a hawkish scenario around you. When the interest rates are really high, in that case, the PEG ratio or the price to earning ratio will be low. And what's the underlying logic? History tells you this. And the second thing is, for all of those who know about the discounted cash flow method, the DCF modeling, you tend to discount the future cash flows by the discount rate. That discount rate is called as the weighted average cost of capital, or simply the cost of capital, or the overall cost of capital. So when you are calculating that, interest rate is a very important component to calculate the cost of capital. How? Your cost of capital, though we have discussed all about that in the curriculum modules and the previous live lectures too, but just to make you have a broader understanding that whenever you are trying to calculate the cost of capital, you calculate the cost of debt and cost of equity. Cost of debt is simple to calculate, right? It's just a given number you have to copy paste. Cost of equity, you tend to use a CAPM model, the capital asset pricing model. And in that, the formula says the risk-free rate plus beta into the equity risk premium. So that risk-free rate is your interest rate. If that interest rate in the market is high, the interest rate in the market is high, your discounting factor will also become high. Your cost of equity will be high. And that cost of equity will translate into a higher WACC. And ultimately, you're using that WACC to discount the future cash flows. For all of those who still don't know how to forecast the future financials of a company, what are free cash flows, like what is discount rate, what is CAPM, watch the modules, please. We have talked about these things in detail. I've talked about this in the curriculum. I've talked about this in my live lectures. I've talked about this via the multiple limited YouTube free videos also. And so please try to watch those. So when the interest rate component is high, that RF component is high in the CAPM model, the cost of equity becomes high. And when the cost of equity becomes high, your cost of capital, that is your WACC, also becomes high. And ultimately, you're using that WACC to discount the future cash flows, right? So you have the free cash flows in the numerator and the WACC in the denominator. And when the WACC is rising, ultimately the valuation will start to come down, right? Because you tend to add the present value of the future cash flows and the present value of the terminal value to get the enterprise value of a firm. And if the discounting factor or the cost of capital in the denominator is high, the valuation will start to come down, right? And if the valuation comes down, your price to earning will also come down and PG also comes down, right? But one thing is, in the past 1-2 years, we haven't seen that. Interest rates have been started to reduce right now, right? The Reserve Bank of India, it has reduced the interest rate from 6.5 to 6.25. The US Fed has reduced the interest rates by some 75 basis point, right? But before even they reduced the interest rates, the market entered into a bubble territory. Still, the valuations became very high. Even in a liquidity crunch environment, even a hawkish environment, the valuations became very high. It means still when the interest rates were high, the valuations were sheerly high. So this inverse relationship, it didn't stand true in the previous context. So that is a practical understanding that we need to have. On a bookish note, in a theoretical language, people will say that interest rate and the price to earning multiple or the price to earnings growth multiple has an inverse relationship, but it might not stand true always. So see the kind of situation practically, and then derive your interpretation towards the price to earning ratio or the price earning growth ratio. Second factor is risk. If the risk in the economy is high, the valuations will come down. Risk, it mostly exhibits an inverse relationship with the price to earning ratio or a price earning growth ratio. When the risk is less, the valuation ratio will be high. When the risk is more, both the price earning growth ratio or the price to earning ratio will be less. And how do we tend to incorporate risk again into the cost of capital? If the firm's risk is high, the interest rate in the environment will also be high, right? Because interest rate is not only governed by the Fed or the RBI, it is also governed by demand supply situations, by risky situations around you. If a company has a higher fiscal deficit, even if that country's central bank reduces the interest rates, the long-term interest rate will still be high because the company has a higher fiscal deficit, the company has higher borrowings, the country is a risky country, right? So that risk gets priced into the interest rate, and the interest rate tends to rise. Risk gets priced into the cost of debt, right? The risk gets priced into the cost of debt and cost of equity both. But ideally, if we talk on the face of it, cost of debt, because if a country has a higher fiscal deficit, the interest rate or the incremental borrowings, that is, the more loans the country takes, will be high. The company won't be getting a lower interest rate because or the company has billions and billions of loans, and if the country is going to take more loans, country I'm saying, not company, country I'm saying, it won't be given loan at a lower interest rate, right? But again, this relationship might not always stand true, as we have seen previously. With the Russia-Ukraine war, be it the Iran-Hamas conflict, still the markets were sheerly high. Third, growth rate. Growth rate, it exhibits a positive relationship with the price to earning ratio. Higher the growth of a company, higher will be the price to earning. And here the growth rate in terms of earnings, in terms of profitability, cash flows, the overall growth of a company. If a company is sustaining that growth, ultimately that will get translated towards a higher price to earning ratio. But in case of a PEG ratio, it always exhibits an inverse U relationship with the PEG ratio. Interest rate and risk exhibit a similar set of relationships, both with the price to earning ratio and the price earning growth ratio. But in terms of the growth factor, it exhibits a positive relationship with the price to earning ratio. But with the price to earning growth ratio, it exhibits an inverse U-shaped relationship. Now, this is not something which I have made, it's a past study that is telling you. Historically, for all the companies, be it large cap, mid cap, small cap, with higher growth, they grow. And once the growth rate and earnings become too high, the PEG ratio tends to fall, as we saw in this example of the mid cap and the small cap space. The price to earning was high, but the growth rate and earnings became superly high, right? Versus the price earning growth ratio, versus the price to earning ratio. Formula price to earning and the growth rate in EPS. If the growth rate in EPS in the denominator is becoming high as compared to the current price to earning ratio, the PEG will start to fall, right? So with the PEG ratio, the growth exhibits an inverse U relationship that we have seen historically from past multiple studies. So that is the relationship with the interest rate, the risk, and the growth. Interest rate and risk almost closer to each other because ultimately be it the higher risk gets priced into the interest rate and a growth is a separate third parameter. Any questions as of now? Anybody? Any questions as of now? Also, see, like one thing also we need to understand is a company which is being trading low at a price to earning multiple. It might appear cheap, but it might not be surely cheap. And the vice versa for the higher price to earning multiple. So for example, if a company is expanding its operations, if a company is expanding its operations into some kind of like, I would say like any kind of industry, be it cement, be it metals, be it into anything, the chances for growth of such companies is much more higher in case of emerging countries versus a developed country. Emerging countries like India, they give you higher growth potential as compared to US companies, correct? So it might happen that a similar company being into cement or metals or infrastructure, it might trade at a very lower valuation in US and a higher valuation in India. Now, the thing is, it might be trading at a higher valuation in India, the price to earning multiple, or the price to book value multiple, or the EV to EBITDA multiple for such companies, right? Might be might seem to be high in India, right? दिखने में लगेगा ज़्यादा, right? But they might not be overvalued because the growth rate for such companies has a higher potential in India. In US, they might appear undervalued, but they might be overvalued. Price to earning के basis पे, price to book value के basis पे, they might seem to be undervalued. But ideally, they will be overvalued because there is no high growth potential in developed countries. But there is a higher growth potential in emerging countries. So for similar companies, the price to earning or the price to book value might be sheerly high, but the growth rate in earnings might be supporting that higher valuation. Because the potential for growth in emerging economies like India is much more higher as compared to the developed economies. That's also one thing. Second scenario that might happen is then a lot of companies are shifting towards new sources of businesses. For example, they're shifting from fossil fuels to clean sources of energy, be it wind, be it solar. There are many businesses who are shifting from the traditional IC engines to EV engines, to EVs. There are many businesses who are shifting from offline movie platforms or medias to OTTs, right? Now the thing is, for these types of companies, ideally, they tend to use a sum of part valuation. That is a part of business which is into down cycle. That is, for example, if a business is focusing towards cleaner sources of energy now, right? It can't just directly shut down the business of fossil fuels, right? Or an EV car manufacturing business can't just directly shut down the business for the IC engine. It will take time, right? But it won't be spending into additional capacities, infrastructures, investment opportunities, or diversification opportunities for the previous business, which has to be discarded. Like, for example, the fossil fuels or the IC engines. But till that point of time, since the demand would still be there for the IC engines, for the fossil fuels to generate energy, the demand would still be there, right? That downward trajectory of that particular part of business or that particular part of business which might not be there in future because that will get replaced by the new business will still make profits. The growth will not be there, but the profits the company will be making because the demand is still there. The company might not be investing into capacity addition for such businesses which might go off the market in the next 2 to 5 years. Correct? So those companies might appear to be cheap on a price to earning basis. Why? Because the EPS of that companies might still be high. The EPS of those companies might still be high. Again, the company might not be doing any kind of capacity addition for such part of business. No debt, right? So no interest payment also, or the interest payment might come down. And as the businesses, such lower down businesses or downgraded businesses, which might go off the business, right? The businesses khatam hone wale hain, be it for fossil fuels. I'm not saying that it will end as of now. It might take years and years and years, maybe like 15 years or 20 years, but like just to have an example. So such kind of business which is going off the market cycle now, they might trade at a lower price to earning multiple because the demand is still there for those businesses. The company will still make profits. The EPS would be high and the price would be low per se. And hence the companies might appear to be cheap. But the other side of business, the new age businesses, the clean energy, the EV side of business, the OTT side of business might appear to be sheerly overvalued based upon price to earning because there's a high growth rate for those companies to grow, higher growth potential for those companies to grow as compared to an IC engine, to an offline media source channel, right? Or maybe towards the fossil fuels, right? So दिखने में the multiple will be high, but ideally it is not high because the growth rate is supporting the pricing because they have a higher growth trajectory. But in the case of fossil fuels, they might appear to be low, but they're not exactly low because the business is bound to go off in future. For business, that unit or that particular unit or that particular segment of that factory or that company shall be discarded off in future. So many of the people tend to use a sum of part valuation for such kind of companies ideally, right? Which should not be done. They separately value the IC business, they separately value the EV business, and then they tend to add. They separately value the wind energy business and separately value the fossil fuel business and then tend to add. They separately value the OTT business and separately value the offline media business and tend to add. It makes no sense because ultimately the new business shall replace the previous business. The OTT business shall replace the offline channels of communications or media. The clean sources of energy business, the wind energy, the solar, will replace the fossil fuels. Maybe 15 years down the line, EV will completely replace the IC engines, right? The new businesses are not creating some additional value. They are replacing the previous businesses. So when a new business is replacing the previous businesses and there's no significant addition to value in terms of margins and cash flows, There is no need to value both the companies separately. Value that entire company as a whole. If two different companies are getting made, then it is important to value such companies separately and then add the valuations. But if not, if a new business is just entirely replacing the previous businesses, right, there is no need to do a sum of parts valuation. We'll talk about sum of parts valuation also. But as of now, any questions upon price to earning or price earning growth from any side of business? Any questions? Any questions, anybody? Any questions, anybody? If no more questions, we can end the session for today. And the previous session, we shall discuss upon the EV to EBITDA ratio. EV to EBITDA, adjusted EBITDA. We'll talk about price to sales, right? And different other adjusted metrics where you tend to face confusion, right? There's also something called as diluted. No, we talked about the diluted EPS. We talked about the basic EPS in the previous session. But the next session shall be subsequently focused towards trying to understand what? Trying to understand your the EV to EBITDA ratio, what is adjusted EBITDA, EV to sales, and price to sales. You can access the recordings on the website itself. So once you open the website, right, if something new has been updated, right, you get a notification or you simply get the name of the module as the updated module or the latest updated module. Either it gets uploaded as the last video on the website. The website will be last video. That's the most recent video. Watch that. If not, you also get the notifications on email. Whenever we upload any new module or the recorded lecture, you get a notification on your email ID that some new thing has been uploaded. And just refer your email ID, just click on that and you shall be directly transferred towards that new video, right? So that is one thing. Go there, search for that. Still, if you aren't able to find it, just feel free to text me on my contact number. I'll try to navigate you. Okay, so not to worry for that. Okay, so we can just end the session for today. Thank you so much, guys. See you in the subsequent session. Thank you.